Good afternoon or good morning, depending on where you're at. This is Curtis Hawks, Chief Marketing Officer over here at Insurance Agency Marketing Services. And I want to thank everybody for taking some time out of their day to be with us. We've got a very important topic and a topic that I think can really shape the planning landscape here for years to come. And so we've got a very special guest speaker on the call with us today. His name is Linus Sugis, and I'll talk a little bit more about him here in a little bit. But before we get into the main event, I did want to take a couple of minutes and talk a little bit about some of the ways IAMS can help and partner with the advisors that we work with. So first off, we've got our new producer builders. And as you can see here, we've got a number of different point levels up here, but this is really our way to meet an advisor where they're at and help them to get to where they want to be. And so you can see as a new producer with IAMS, as you're producing business with us, there's a variety of resources that you can tap into to help accelerate your business, whether it's marketing, cash, marketing dollars, trips, a number of different things. And if you have questions on that, I would tell you reach out, talk to one of the sales directors over here. They can answer any of the questions that you have. I would also tell you that one of the core pillars of IAMS that you'll find about us is customization of services and really having a high level of service. And so if you're doing something right now that's working really, really well for you, reach out and talk to a sales director because we can certainly work with you on partnering with you on that as well. In addition to that, we've got our IAMS Business Builders, and you can see here we've got a few different programs. One is our Referred Producer Program. So for those of you that currently work with us, if you happen to know somebody who maybe isn't quite happy or satisfied with their current relationship, send them our way. Not only will you get a $50 bonus when they initially get contracted, but you'll get an additional $100 bonus when they write their first piece of business, and then on an ongoing basis, you will get additional dollars on their production. And the nice thing for you is you don't have to do anything. We'll take care of all the service, we'll take care of the agent, all of that. You're just getting checks cut to you on a quarterly basis. In addition to that, we have our marketing reimbursement program. And this is a really a great way to double the size of your marketing budget. And that's one of the things that I think we've seen here over the course of the last year as we continue to plod back to a new normal is that depending on where you're at, you have to spend a little bit more money on advertising to generate that consistent flow of prospects. And so as you can see there, for every $100,000 of index annuity premium, you'll accrue an additional 100 marketing dollars. And then $200 for every 100,000 of SPL and $200 for every 10,000 of target life premium. And if you'd like some more details on how that program works, certainly reach out and talk to one of the sales directors over here. Back office support. I think that's really been highlighted here over the course of the last year as we've had carriers go remote. I think a lot of people have seen some bottlenecks at the carrier level, and so having a really good team, a knowledgeable team at your IMO that can help push things through, and also have a quick response, whether it's case design, marketing, rates, any of those types of things. And so I would encourage you, if you haven't experienced our back office support, I would encourage you to try it out. I think what you'll find is you'll be very pleased with the service level and our attention to detail. As we all know, technology has been a big theme here over the last year. One of the things that I think we pride ourselves on is that for a number of years we've been very tech focused. And so one of the ways that we do that is making sure that we have single sign-on on our website. So we do integrate with Firelight. As you can see here, we've got a number of carriers available and a number of carriers that we're in the process of adding on as well. But e-applications, whether it's on the annuity side, the life insurance side, we also integrate with iPipeline. We've got a number of resources on the site to help facilitate both live and virtual sales. Our creative marketing solutions, and I really think creative is the key word. One of the things that we've found over the course of the last year is a lot of advisors were doing certain mixes of marketing strategies pre-COVID. And then once it hit, they really had to start rethinking what they were doing and how they were going to market and prospect. And we saw a lot of changes and a lot of evolution in the marketplace. And so one of the things that I would mention to everybody is, and I'm going to launch our first poll here, but we do provide a complementary marketing analysis, and we're right now coming up on the halfway point of the year. And this is a great time to take a step back and evaluate what is your current marketing mix year to date. And as we look toward the second half of the year, what do we want things to look like, and what do we think we need to customize? And so in this process, what we'll do is identify the target market, the geographic location you're marketing in, what your mix of strategies are, and then come back with a customized marketing report that has various recommendations. And what I would tell you too is with our team, they're very, very good. So whether it's straight lead gen, it's web design, logos, business cards, print collateral, you name it. They're very well versed and can help in all those areas. So I'll go ahead and close down this first poll. And moving on to next slide, our website. As I mentioned, we've got multiple EAP platforms on the site, and we really designed our site to be kind of a one-stop place for you to access anything that you need, whether it's to run annuity quotes, life insurance quotes, do e-applications. One thing I would mention to you is we do have our sales resource library on there, which has literally hundreds of different pieces that are all point of sale consumer facing pieces. And it's got a range of topics, whether you're looking for something like annuity or life insurance basics to loan regime or economic split dollar. It's got everything on each end of the spectrum and everything in between. And so it's really a great resource, and you can download those pieces right off of our website. To that end, when we talk about technology and those types of services, Retirement Analyzer is a software platform that we integrate with. The number one fear of retirees is outliving their income in retirement. And Retirement Analyzer does a very effective job in a very simple and straightforward manner of showing somebody how long their income is going to last, and if it's not going to last through retirement, what needs to happen to fix that. And I'd also add in as well, not only do we have Retirement Analyzer available for our agents, which you can get access to for free, we also have Stonewood software as well. And so for those of you that are in the overfunded life insurance space, that's a great resource to illustrate the impact of taxation on somebody's income in retirement. And you can actually get access to that for free through us as well. I would encourage you, if you've got questions on that, to reach out and talk to one of the sales directors over here. IAMS Wealth Management. For those of you that don't know, we set up an RIA a few years ago, and it has really just had significant growth in that time frame. And right now is a great time if you're looking at trying to start gathering assets, or maybe you're not quite happy with your current relationship. Charles and his team do an amazing job. Right now is a really good time to look into that. And if you've got questions on it, I would encourage you to reach out to Charles and his team, and they can certainly answer any questions that you might have and talk to you a little bit about how they make a difference in an advisor's practice. Next up, I wanted to talk about some of the events that we have coming up. First off, we announced our Top Producer Summit in January this year. You can see it as a Mediterranean cruise. And so we'll be working our way around the boot of Italy. And, we're very, very excited about this event. It's going to be very high-end, concierge level. And a core element of who we are is being able to spend time with our advisors. And so last year was a tough year, having to postpone or cancel most of our events, but we do have this on the docket for next year. You'll also notice that there's an 18-month window to qualify. So it's 4.5 million points to qualify. And I would encourage you to reach out, talk to one of your sales directors, and then get you some more information on that. In addition to that, we recently announced our Escape to Paradise incentive trip. This is an Athene trip. So based off of Athene annuity production, you can see it's $2 million to qualify, but we're going to be going out to Hilton Head, and we've got some very nice venues, some very good golf courses that we're going to be going to. And so we're very excited about this and being able to do that type of an event as well next year. Qualification period runs through the end of this year. And I would encourage you, if you've got questions on that, to reach out and talk to one of your sales directors over here. I did also want to mention as well, and I don't have a slide for this, but we did just set our first Life and Annuity Academy. And so it's going to be the latter part of this year at the, it's going to be end of September. and then I think the first day of October as well. But we're really excited about that. We normally do several of those over the course of a year. Last year we weren't able to do any, and so we've got our first one. If you do have interest in attending one of those, I'm going to launch a poll up here. Go ahead and check yes if you have interest in attending one of those. But it really is a nice 2-day training to where we do a deep dive into advanced planning strategies in the annuity space and the life insurance space. We do a deep dive into marketing strategies, into digital marketing, and it's really a good opportunity to spend some time working on your business. So much of our time is spent working in the business and prospecting and marketing and working with clients, all of that. And the ability to take a couple of days out, get out of the field, and focus on your business and what you want it to look like, and learn tools and ideas and strategies that can make an impact of it is invaluable. So I'm getting ready to shut this down, but definitely if you've got questions on that, you can reach out, talk to one of the sales directors over here. And obviously we'll be following up with you as well with the poll. So last thing before we get into the main presentation, we are on social media on both Facebook and LinkedIn. So if you like and follow us, we are every week putting out new updates on whether it's rates or marketing or what have you, but it's a great way to connect with us and see what's going on over here. So with all that being said, I am very excited to be kicking off our second webinar series of the year, which is Storm on the Horizon, Legislative Risk and the Impact on Taxes. You don't have to look very far to see in the news a lot of discussion about legislation right now and tax increases. In fact, the proposed tax increase that we're looking at is the largest tax increase since 1993. And so to that end, we thought it would be a good idea to put together a 3-part series where we really kind of do a deep dive into what does that mean, what's going on, if we think taxes are going up, what are the strategies and ideas that we should be looking at. And so we've actually got a really neat package that we'll talk about at the end of the presentation. But to kick off the first of this 3-part series, I've got Linus Sugis on the call with us, and he is what I would tell you one of the brightest minds out there in the financial services space. I always make a joke about this. When I first got started, I remember I had an advanced markets case, and so I called up to an insurance company, and they're like, "Oh, well, you've got to call this company Advanced Underwriting Consultants." And I was like, "You guys don't have an advanced markets team?" And like, "No, we use this company over here." And so I got introduced to Linus, and this is 19 years ago. And Linus's company that he set up is Advanced Underwriting Consultants, and they basically are some of the smartest people that you'll find out there in this space. And they work with insurance companies, brokers, you name it, to where if you need advanced markets help, you can talk to Linus as well as his team, and they can basically answer any question that you have. In fact, it's a running joke that I talk about, because in 19 years, I don't know that I've ever called Linus and asked him a question where he told me, "Well, let me check, I'm not sure." I mean, the guy is just an encyclopedia of knowledge. So in any case, I couldn't think of anybody better to kick this off with than Linus. So Linus, I really appreciate you taking some time out of your day today. I know you're very busy, but really appreciate you taking some time with us today to talk about these topics.
Curtis, it's a pleasure to be with you, and I am going to bottle that introduction and use it over and over again. Thank you so much. That was very generous.
Absolutely. So so let's get into the meat of this. So right now, what not only our advisors but consumers, they're seeing a lot of information out there on the American Jobs Plan, the American Families Plan, and obviously over the course of the last year, we've had the CARES Act, the Consolidated, just a lot of stuff going on. But what's in the headlines right now is the American Jobs Plan, the Families Plan. When you look at it from your perspective, what are some of the more provocative items that are in these packages?
Yeah. First of all, I think for those who were on the call, Curtis, I think it's important to remind them that both the packages, the Jobs Plan and the Families Plan, are proposals. They're aspirational objectives championed by the Biden administration. That's not to say that they won't get some of the stuff through, but I think it's good to know that these aren't givens. And the fact of the matter is that it's a really thin majority for the Democrats in Congress. And so very difficult to build a complete consensus on the Democratic side because there are a lot of different points of view. But as I said, this is aspirational on the part of the Biden administration. Whatever they're able to pass will certainly have elements of what it is that we're going to talk about. But let's talk specifically about what their aspirations are. You asked specifically about the American Jobs Plan first. And the objective of that legislation, or the main objectives of that legislation on the positive side, on the goals side, seem to be to invest in infrastructure, although we can argue that there are plenty of other things that are being invested in that aren't really infrastructure, but to invest in infrastructure first, and second, to invest in job training. Well, taken in the abstract, investing in infrastructure and investing in job training are great, right? Until you try to figure out how you're going to pay for the specific things that you're putting into the bill. And really that's the source of what we're talking about today. The tax provisions that are part of the American Jobs Plan, the main ones that I think are of interest and concern to us and to our best clients are, first of all, there's a portion that seeks to increase the corporate income tax rate for C corporations from the current 21% to 28%. Remember, as part of the Tax Cut and Jobs Act, the C corporation income tax rate was reduced from a top rate of 35% to a rate of 21%. And so it made it much more attractive for our clients to consider adding C corporations to their mix of companies if they didn't already have one. Well, this kind of undoes some of that. It will be less attractive to be a C corporation or to have a C corporation in the mix of companies if the C corporation income tax rate is raised. I suppose the positive from a C corporation perspective is that if you have a deductible expense for the company, the deduction will now be more valuable, but that's really trying to find the bright spot on something that's pretty negative from a corporate perspective. So for our business owning clients, that's certainly a negative in the American Jobs Plan. A significant portion of the money needed to pay for the infrastructure changes, the job training changes, is going to come from an increase in the corporate income tax rate. And in further bad news for C corporations, the American Jobs Plan is going to seek to impose a new kind of alternative minimum tax on a C corporation. For those of you who've been in our business for more than a decade, you may remember the corporate alternative minimum tax and how it might apply to life insurance and make part of the life insurance death benefit income taxable. Well, the new corporate AMT isn't going to be like that, but it will essentially penalize corporations that make a lot of money, that accumulate a lot of assets over time, and will be kind of an indirect asset-based tax on C corporations. And so both of those proposed changes together will make it less attractive for our clients to operate C corporations, and I suppose relatively more attractive for clients who are business owners to favor, again, pass-through entities like S corporations, partnerships, sole proprietorships. So, that's the quick overview of what I see on the American Jobs Plan. Now, on the American Families Plan, again, great goals as part of what's being discussed there. They're talking about funding 4 years of higher education for virtually everyone. That sounds great. If you're either a pending college student or the family that's trying to figure out how to pay for college students' higher education, the idea of, quote, free higher education certainly sounds attractive. We, of course, understand that all those things have to be paid for. There's also part of the American Families Plan that will enhance child care and paid family leave. And again, all that sounds great, but how are we going to pay for it? Well, the tax increase associated with that is a lot more likely to affect our clients, even more than the C corporation proposals as part of the jobs plan. In the families plan, there's a lot that Congress is considering or will be considering to increase revenues. The first of which is not a direct tax at all, but they recognize the IRS probably doesn't have enough money to effectively enforce even the rules that we've got so far. So they've allocated a substantial amount of money to make sure that the IRS has a stronger ability to enforce the tax rules that are ultimately part of the American Families Plan. And they're probably going to need it because they're talking about increasing the top income tax rates from the current 37% to 39.6%. And so that's a significant increase for high income people. They're also talking about increasing the capital gains rate from the current maximum 20% for taxpayers to 39.6% for those who have income in excess of $1 million. So that would make the capital gains rate the same as the income tax rate for those who make $1 million or more of taxable income in a year, combined earnings, investments, capital gains recognition. If you're over $1 million, you'll be paying at 39.6 on everything over $1 million. And to add a little bit of insult to injury, I suppose, an additional proposal as part of the American Families Plan is to extend the Obamacare surtax. Currently, the Obamacare surtax applies only to net investment income over certain thresholds for taxpayers, and it's a 3.8% extra tax. The joke I like to tell is, why do they call it a surtax? And the answer is that they want to disguise the fact that it's an income tax. They want to call it something else other than income tax. They don't want people to recognize that this is effectively another income tax. But it is. It's an income tax. And the change proposed as part of the American Families Plan would make the Obamacare surtax apply not only to net investment income over a certain threshold, but to all income, including earned income, in excess of if someone's making more than 400 grand of combined income in a year. And so the 3.8% surtax would apply to more income, making the top effective income tax rate for high income people 43.4%. Would extend the scope of the old 43.4% top income to all kinds of income for high income, high net worth people. And so as we're talking to our clients, we have to kind of keep those things in mind. Our clients are reading about that. We need to just kind of talk through what the impact might be for them at their income levels.
So, I know you're kind of covering a little bit of this, but in looking at that and looking at kind of the good and the bad, what do we think that some of the net impact of that's going to be on these?
Yeah, so I mean, look, if C corporation, I mean, let's talk about the jobs plan first and the increase in taxes for C corporations. So what happens when people pay higher income tax rates? They either try to suppress income or they might distribute it out to their own hands. They won't keep it in the business. They won't keep income in the business. They'll distribute it out. And so I think there's a real danger that C corporations going forward, if their income tax rates are higher, that they will be less inclined to keep their money. They'll be less inclined to hang on to after-tax money for the purpose of reinvesting in the business long term. And I think that's a problem, right? I mean, part of the reason that you put together a C corporation, if you're the owner, is you don't need all the money that the company makes to live on. You're going to have the company reinvest some of its money and invest in more employment, invest in more equipment, invest in expansion of the business. Well, if the C corporation rate is higher, there's less money available for that, and so the incentive to keep it is much less. And I think that's something that our C corporation owning clients will certainly evaluate and need to think about. So an unintended consequence of that kind of change might be less corporate investment and growth. If the long-term cost of investing in capital assets goes up for high net worth people, which is what the American Families Plan is proposing, if there are higher capital gains rates, if there are higher income tax rates, it's going to be harder for people to effectively invest for retirement. People will have less money available to invest after tax to help companies raise money through bonds or through selling more stock. And so I think there's a real danger with the tax rates going up on the personal side as well. There's a real danger that there'll be less investment in our country. And so the potential for long-term economic growth will be potentially suppressed. And of course, one of the things that our high income clients are going to be very interested in as they talk with us is what they can do to try to minimize their income tax exposure if the American Families Plan and its tax increases become reality. So there's some positives, though, I think, as part of what are being discussed. For our business, the life insurance business, there's no discussion that I've heard about taking away the current tax advantages of permanent life insurance. And of course, those are tax deferred growth, tax advantage access to cash during lifetime through combination of withdrawals up the basis, loans thereafter for a non-MEC contract. Those lifetime distributions are tax-free. Those are cornerstones of the banking on yourself kind of philosophy, but that's been an idea that's been effective and in place for a long time. We've got access to tax-free death benefit on a life insurance policy. And for many of the modern products that have accelerations for things like chronic illness, for terminal illness, potentially for critical illness as well, those features will generally produce a tax-free benefit as well. And so life insurance looks as good as it ever has, and in a rising income tax environment, those natural advantages look even better than they have in the past, and it's certainly something for us to talk about. I would also mention it's not just life insurance that's part of the advantage. Annuities with some of their modern features will look more attractive. Annuities have natural tax deferred growth for individuals who are owners. They have terrific features, some including long-term care, some including enhanced income riders that'll help people plan for a good retirement and protect against risks associated with retirement. And so annuities as well, particularly because of the tax deferred growth and those product features, I think they look as good as ever and perhaps even better in a rising income tax rate environment.
Okay. So I know a lot of what's in the media right now is discussion about high net worth. And if you only make so much money, then you don't have to worry about this. But, what if any impact does the middle market, or are they going to see from the potential legislation?
Yeah, that's funny. Everybody I talk to thinks they're in the middle market, right? Even our most successful clients think they're, somehow in the middle market. At least that's my impression. And so it depends on how you define the middle market. I certainly don't want to rely on what Washington thinks is the middle market, because they're going to get it wrong. And they're probably going to put me in a category, and a lot of our listeners in a category that we don't think that we necessarily fall into. So defining the middle market is always kind of tricky. It's one of those, I think, rhetorical tools that's used to try to support legislation either one way or another. But I digress. Curtis, to more directly answer your question, I think the middle market, if we're talking about middle class, lower middle class, depending on how you define that, some are going to perceive advantages of either one of the plans, either the American Jobs Plan or the American Families Plan, because they think, well, it means better infrastructure. Who can argue with that? They will say, well, no cost higher education like college, that's going to be great, right? Means that we don't have to worry about providing that money for our kids. More money for us to be able to do other things with, perhaps plan for retirement, perhaps to spend on something else. For those people who perceive those advantages and who perhaps would not be directly affected by the higher income tax rates or higher capital gains rates, don't have to worry about the Obamacare surtax, don't run C corporations, they're going to be less affected, and they're going to see the positives in what's being proposed. For our business owner clients, for our affluent clients, those who have successfully invested, and especially those who are nearing what they hope will be a financially successful retirement, the costs may end up being higher than the benefits from what's being proposed. Taxes are likely to go up for a significant portion of those who consider themselves to be middle class. Otherwise, it doesn't work. I mean, just raising taxes on the really high net worth won't raise enough revenue to bring the budget closer to balance. Some who consider themselves middle market will experience tax increases, and that's a problem for them. And I suppose it's an opportunity for those of us on the call. It's always fashionable to think about strategies which will manage tax results. And as I mentioned earlier, permanent life insurance, annuities, other financial products that have tax deferred elements or tax favored elements in them are going to be more attractive as we go forward. And it's certainly something for us to talk about as we are visiting with our best clients, encouraging them to position perhaps more assets in the tax advantage portions of their portfolios.
Linus, one question that was posed to me the other day that I thought was good is, we're talking about the middle market, and there's a lot of small business owners out there where, their end goal at some point in time is they're going to retire and they're going to sell the business. And so they might have a year where they theoretically happen to have a really high income because they sold the value of that business, and that's going to kind of be their retirement nest egg. Is there the potential for those individuals to where when they have that 1 year where they have a really high income, that can have a negative impact with some of these changes where otherwise they wouldn't have seen that necessarily?
Sure. I mean, we get calls about that. Yeah, it's a great point, Curtis. We get calls about this all the time, right? People are wondering, if there's anything they can do. They're about to sell something, whether it's a business or a commercial property or some highly appreciated asset, and they want to avoid the income tax result this year. And, what we're telling them as part of the conversation is, wait, you better really think about this. Capital gains rates for capital assets, they stop at, even if you take the Obamacare surtax into account, they stop at 23.8%. If you've got a choice between that rate and what the rate might be tomorrow, perhaps as high as 43.4%, you might think about just eating the tax eating the tax sooner rather than later before, before the rules change in a way that is not favorable to you. So yeah, I mean, look, everybody on this call, answers questions about their clients and, managing taxes. And those things do need to be pretty carefully considered. It appears as if income tax rates will go up. Exactly how they'll go up is up for debate, but the income tax rates will go up. And you're right, if somebody is planning to sell something, they ought to think about the potential consequences of that now in making the sell decision, and also in how to put together the shape of the agreement over what it is they're going to sell.
Okay. So, I think that gets to the central topic, which is legislative risk, Congress's ability to shape the tax rate environment in the future. In your opinion, and we're going through this right now, but what are some of the best ways to plan for legislative risk?
Yeah, so yeah, it's a really good question, and the answer is I'm a big believer in tax diversification, right? We diversify investments when we help clients put together financial plans. We diversify risk, but I think it's also important for our clients to diversify with regard to the tax results associated with turning their investments into money when money is needed. And so having several kinds of buckets, perhaps, qualified plan bucket where, you save taxes today, but distributions are taxable in the future. An annuities bucket where you've got some money that's growing tax deferred, and you've got some ability to decide later on when to take distributions, and when you're going to eat the income tax result associated with taking the distributions. And then, permanent life insurance and Roth IRA money, which can be built to be tax-free. Having those types of diversified investments, I think, will help people who are at or nearing retirement minimize the impact of what might happen. Now, their heirs may end up, dealing with it as well later on, but it's a more immediate kind of thing for our clients to plan around retirement. And so I think tax diversification is certainly something that we can do right now for folks who are in those circumstances, either at or nearing retirement. And it's never a bad strategy to tax diversify, no matter who it is that you're dealing with, because starting early, as we know, is one way to make sure your choices are greater as you run on down the road. I'm a conservative guy by nature. You can probably tell from some of the stuff that I'm saying. And, from my perspective, my advice to people who ask what it is that they ought to do is that they should make small changes today based on what they think might happen, rather than large changes today. And then it turns out that what they're fearing is going to happen doesn't actually happen. Because making changes is expensive. Sometimes it's a direct expense that has to be incurred, and other times it's an expense in terms of worry and in terms of logistics in order to pull a change off. And so, I'm not, particularly at this time when we're not quite sure what's going to come out of Washington, I'm not a big believer in making monumental changes, but I think our clients need to think about these issues, and there's certainly something for us to talk to them about. And so small changes, adding tax diversification in particular, is something that I would recommend. The one area that people, I think, our most high net worth clients may be inclined to take bigger steps is over the potential change in the estate taxes. We're talking about the Biden administration having an aspiration. We didn't talk about this as part of the jobs plan or the families plan because it's a separate aspiration. But the Biden administration has an aspiration to significantly change the way that the estate tax works, significantly lowering the exemption amount from its current $11.7 million per person level, potentially increasing the estate tax rate, and also potentially changing the step up in basis at death. Those are all things that are potentially on the table. Particularly the lowering of the federal estate tax exemption amount, if it happens, is going to throw a real monkey wrench into the plans of our high net worth people. And those folks should certainly be thinking about making gifts now, because the rules seem to favor making gifts now. It feels like that ultimately their families will be better off if sizable gifts are made now. After the older generation is gone, the family will end up being able to keep more assets.
Well, and I think that's an interesting point you make, because we've got, the next question I have for you is on the Tax Cuts and Jobs Act, and that's, I believe in 2017, that's when we saw that significant increase in the estate tax credit. And so, we've got these two pieces of legislation right now, but we also have the potential sunsetting in 2025 of the TCJA. And so, from your perspective, if you were going to speculate a little bit, what do you think we're going to see here over the next few years?
Well, I think the main thing is that the Biden administration can use that sunsetting as a lever, right? Assuming that there's no turnover in control of Congress, the fact that it's going to happen automatically in 2026, that the estate tax exemption is going to revert to about $6 million adjusted for inflation per person, about half of what it is today. That's a real lever, right? It may be that the Republicans will be willing to compromise on some kind of legislation so that that doesn't actually happen. And so, that's the bargaining chip, I suppose, that the Biden administration and the Democrats have, is the sunset there. I think, as I mentioned previously, for our clients are still going to be worried about this. If there's continues to be stalemate in Washington, I think it makes sense for our high net worth clients to think about using up their exemptions today, $11.7 million of exemption today, if they can afford it, particularly with assets that are likely to grow. The IRS seems to have said that they're going to leave those types of gifts alone and aren't going to penalize people. And gifts can be fancy or they can be simple, but it's certainly a conversation that we might ought to engage with people about. But that's how I see sunset. The threat of sunset is the main bargaining chip that the that the Biden administration has in negotiating with the Republican side of the aisle.
Okay. Do you have any, in regard to business owners? I know one of the things in the TCJA was that 199A deduction. Do you have a sense or a feeling of whether that sticks around or if that disappears?
Yeah, I think it probably stays, unless it ends up being a bargaining chip on getting something else. Our pass-through, not every pass-through business is eligible for it. Those who are in service businesses, it's hard for them to rely on it being available, for example. So it probably stays, at least for the time being. I haven't heard much active talk about it being repealed, but that doesn't mean anything, because right now, even stuff that isn't explicitly on the table may apparently be on the table.
Okay. So, to kind of put this all together, I mean, I think a lot of the people on this call, myself included, I think we believe that, generally speaking, I think we're going to see increases in taxes here, over the next several years. So, from your perspective, if we believe or think that we're going to be going into an increased tax rate environment or increased tax revenue environment, what are some considerations or ideas or things that advisors should be talking to their prospects and clients about?
it's a great wrap-up question, Curtis. From my perspective, the thing that I mentioned about tax diversification is probably the thing that would get the single widest play um, that is related to taxes. From my perspective, we ought to be talking to all of our clients about tax diversification so that they've got the ability to minimize the risk associated with any changes that are ultimately made in the income tax code. Um, Life insurance and annuities can play an important role there. Roth conversions ought to be thought about. Roth contributions ought to be thought about. But tax diversification is probably the first thing on the list that would get the widest audience in connection with, the changes that might be made. For our high net worth people, they've already been made aware, pretty much for sure, that the estate tax rules are likely to change. We ought to be engaging them in conversations about gifts, whether they're gifts to family, whether they're gifts to charity. We certainly ought to be engaging them in conversations about life insurance and the role that it might play in connection with estate tax management and any future estate taxes that might apply to their families. And then in any kind of environment, but particularly in an environment that is uncertain from a tax perspective, I like to remind life insurance professionals, financial professionals, that are certain kinds of timeless ideas that no matter what happens tax-wise, should get a favorable audience with our clients, with our prospects. And there are two ideas that I like to hit over and over again. The first one is the beneficiary designation review. It's such a simple thing, right? People have beneficiary designations for life insurance, for annuities, for IRAs, for qualified accounts, for all kinds of different assets. And a lot of times, at least based on my experience when I was doing estate planning work as an estate planning attorney, a lot of times those designations are flat out wrong. And so one of the best things we can do with our clients is ask them to gather up all of their beneficiary designations, look them over with our clients, and make sure that they're right. Make sure that little kids aren't in line for money. Make sure that the estate is not in line. Their estates are not in line for money. Forcing assets through the probate process. We want to make sure that their beneficiary designations are tight, are going to control their liquid wealth in the way that our clients want that liquid wealth controlled. And even if we don't sell them a thing, helping them do that really serves them and tightens our relationship with them. So that's the one non-tax thing that I'd mention. The second non-tax thing that I'd mention is directed toward our business owner clients. I think the most valuable conversation or series of conversations that we can have with our business owner clients has to do with their plans for what happens if something happens to them. It's not necessarily buy-sell planning. Buy-sell planning doesn't work for everyone. Certainly in some family-owned businesses, for example, testamentary documents like wills or trusts can handle the transfer of the business from one generation to the next. But plans need to be made. If our clients have put together a business entity, a business organization that has value for them, that has value for their families, doesn't it make sense for them to make sensible plans to preserve that value in the event something happens to them? Doesn't it make sense to them to have a plan for cashing out at retirement if that's what our clients want to do? And so engaging in that conversation, being an effective coach with our clients about what their plans are, make sure that that we're playing devil's advocates when our clients' plans make no sense. I think we can really serve our clients well with those types of conversations. And so, from a tax and non-tax perspective, I think those are the kinds of things that the folks on this call could be talking to their clients about right now.
Well, and I think those are all very good points. And Linus, I appreciate you taking some time with us today to share your thoughts and take a deep dive into a number of different items. And so, as I'd mentioned at the beginning of the call, one of the things, and I'm going to launch our final poll. But one of the things that we're going to be rolling out next week is a macro tax planning kit. And so basically, this package encompasses a number of different pieces that touch on the different points that Linus was making over the course of the presentation today. In addition to that, we have a number of different marketing pieces in there, whether it's workshop presentation, social media marketing, email marketing, all those types of things to really market uh, the impact of uh, legislative risk and some of the things that are going on in the marketplace. And so I wanted to get this last poll up. We are going to be rolling it out next week, but I figured a lot of the people on the call today probably are going to be interested in getting that. And so it's a very nice package, and you'll get a link, and you can literally download. I think we've got like 23 pieces in there, so it's a very robust, built-out package. So I'll go ahead and getting ready to shut this down here in a minute, but in any case, I think, Linus, that's always the thing, right? When we talk about legislative risk, because there's always something going on. I mean, we saw that with the Secure Act last year, and so I think you made a good point about this is always something that's out there, and I like that point you made about making little changes as we go forward, because you never quite know what's going to happen, even if we do think that generally taxes are going to be going up.
Yeah, I agree. That's exactly right, Curtis. I'm a conservative guy, so I tend to think small changes are best.
Yep. So I'll go ahead and I'm gonna close this down. And so in any case, so be on the lookout for that. Secondly, this is the first of a three-part series. So we'll be having another call here in about 30 days. So be on the lookout for that. And reach out and talk to a sales director. I know we covered a lot of topics, a lot of information. They're here as a resource for you. And I appreciate everybody taking some time out of their day to spend with us. And hope you have a good, productive balance of the day. Thank you.